when we look at maybe comparing 2020 to 24-25, overall costs on a dairy farm has increased by 46%. But also what's quite noticeable in that 4 to 5 year period since 2020 has been the increase in concentrate costs and how much that now is contributing to the increase in overall costs of a dairy farmer running their business. Concentrate costs are up over 55%, nearly 56%. And on average, I think last year, concentrate costs as on a cents per litre basis was equated to 9 cents a litre of the overall costs of running your business.
With Co-ops currently announcing milk prices for January supplies, the reality is now beginning to bite. While people knew the price cuts were going to be significant, solids for November and December supplies buffered the impact. Now, as milk supply starts again for 2026, solids close to base will see milk prices that may be at or even below the cost of production at this current time. Today, I'm joined by Donal Whelton, Head of Agri at AIB, who are one of the sponsors of the Grass 10 programme, to discuss how dairy farms are fixed financially right now and what they need to focus on to get through 2026. I started by asking Donal to give us a picture of how dairy farms are fixed financially right now.
From a banking perspective, it's probably important just to put it into context about where the sector is and how we view the sector coming into 2026, which looks like it's going to be a little bit more trickier than obviously the last couple of years for the dairy sector. But I suppose when you stand back and look at where the sector is at currently, I suppose, and one of the first things you'd have to look at is what's the overall debt levels on Irish farms currently and where that has evolved over the last maybe 10 or 15 years. And when we look at that, where we ended up by quarter four of 2025, debt levels had nearly halved over the last 20 years. So back in 2009, debt levels on Irish farms had peaked at 5.2 billion euros. And every year since then, we've seen a reduction in the level of debt that Irish farmers have borrowed across all financial institutions, I should say, and across all sectors, not just the dairy sector. But that has reduced down to about 2.7, 2.8 billion by quarter three of 2025. The other thing that we look at, Stuart, is what's happening on the other side of the balance sheet. So what's happening with regard to cash balances and also maybe resources on deposit accounts in the agricultural sector. And I should qualify this by this, what I'm quoting here is Central Bank of Ireland data and publicly available data. So on the other side of the coin or the other side of the balance sheet, when we look at cash balances and what's been happening in that, in that side. So again, that's a very good news story for the Irish agricultural sector. So we've seen nearly cash balances double over the last 15 years. And again, maybe going back to 2009, and I mentioned there that debt on Irish farms peaked at 5.2 billion. At that stage, Irish farmers had about 3 billion in credit current accounts or in deposit accounts, according to the Central Bank of Ireland data. Fast forward to quarter three to 2025, as I mentioned, debt levels have reduced to 2.6, 2.7, 2.8 billion euros, but cash balances have actually doubled. We've now over 6 billion in cash balances available to the Irish agricultural sector, Central Bank of Ireland data. And from a banking perspective, Stuart, that loan, that's a criteria, I suppose we look at it at portfolio level, that loan to deposit ratio. And again, it's a very strong indicator of how the sector has performed so well, and so maybe has such a good track record among all bankers over the last number of years because of that strong debt pay down, but also the accumulation of cash that we're seeing.
Okay, so then, Donald, does that kind of suggest then that the likes of the overdraft isn't, what level of utilisation of overdraft do you see, or do you still see a significant level of overdraft, but the overall net cash flow position is quite good then at the end of the year or whatever, like?
100%. So again, this is something that we've been tracking, Stuart, for our own portfolio, both at an agricultural portfolio level, but we also look at it at a subsector level. So we look at individual subsectors. So again, for the dairy sector, when we look at 2025 data, we are entering now into 2026 with the second lowest level of overdraft utilisation that we can see since we've been coordinating or collecting this data, and we've been collecting this data for nearly 20 years. So the lowest, Stuart, no surprise, was back in 2022. We saw that then obviously throughout 2023, and it peaked again in maybe quarter one of 2024. Obviously, the poor weather, similar to what we are currently experiencing at the moment. Overdraft utilisation peaked, but but then it got again towards the second half of 2024 and right throughout 2025, the overdraft utilisation now has been is currently at its second lowest level since we've been recording that data. So again, and that's a good indicator of the financial strength, Stuart, of a sector. So dairy farmers haven't been needing to dip into their overdraft to fund their business because the cash flow from their operation has been so strong, which is no surprise given the profitability in the sector probably for the last 12 or 18 months.
I suppose the one thing is that the costs have gone up a lot though, Donald. Like, I mean, you're probably looking at a situation now where a person might have had a 30 or 40,000 euro overdraft that you nearly need to be given a month and a half times that now to actually keep the business going, just the way costs have gone. What's your view from the bank side in relation to the costs?
Yeah, and it's something that's noticeable, Stuart. I suppose obviously we keep an eye on it from the audited accounts that we get in, and we benchmark year on year. But we also keep an eye on Teagasc profit monitor data, and obviously when looking at even Teagasc National Farm Survey data, and looking at the cost creep that's evident, particularly over the last 4 or 5 years. When we look at maybe comparing 2020 to 24-25. Overall costs on a dairy farm has increased by 46%. And then you ask yourself, what's been driving that overall increase in costs? And not surprisingly, obviously, with the Russian-Ukraine conflict, we've seen an increase in fertiliser costs, particularly in 2022. That's reflected also in increase in energy costs, fertiliser costs up 40-something%, energy and fuel up nearly 50%. But also what's quite noticeable in that 4 to 5 year period since 2020 has been the increase in concentrate costs and how much that now is contributing to the increase in overall costs of a dairy farmer running their business. And I think concentrate costs are up nearly over 55%, nearly 56%. And on average, I think last year concentrate costs as on a cents per litre basis was equated to 9 cents a litre of the overall costs of running your business. And I suppose coming into 2026, when we know is going to be a little bit more challenging in terms of output price, I suppose it is an opportunity for some guys to look at where exactly they're offside and is there some areas of the costs that they can look at to maybe replicate or to strip out of their business if possible.
So that 9 cent a litre then, Donald, that's a figure that you've seen from the information coming into you yourselves, or is it information that you're gathering from, we'll say, the National Farm Survey, as you mentioned there, like, or maybe seeing people's profit monitors and stuff like that?
Combination of all three.
A combination of all, yeah. But yeah, no, it's just interesting that it's so close to what we've been seeing as well. Like, you know, that like profit monitor isn't done by enough people really, but like at the same time, it seems to be a very good representation of what's out there. The few that are done, or the 1,000 or 1,200 of them that are done in the year, like.
And I think it was like IFAC, in fairness, put out a report there late last year in relation to what they're seeing in 2025 accounts from the accounts that they had done at that stage. And again, I think the average costs on farms were about 42 cents a litre. But I suppose what was more concerning was the range within that, from maybe low to mid 30s costs of production up to maybe low to mid 50 cents a litre cost of production. It's that range. It's probably that's the concern, you know.
Yeah, okay. So I suppose when you think back to what you were saying there about the lending levels and so forth back in 2009, obviously we had a huge investment in farm waste management schemes and so forth at that time. Kind of getting into that cycle where we're coming around to having to do that again. What's the thinking in AIB and across the sector as a whole in terms of the investment appetite that's in the sector? And obviously you're quite happy to lend to the sector given the figures you've been talking about there, but have you got people coming to you looking for money for storage, or what are the kind of the big ticket items that you're seeing that people are coming for all the time?
Yeah, I suppose just to maybe set the scene first and ask the question, Stuart, what level of debt do Irish farmers borrow every year? And again, all sectors across all financial institutions, and again, looking at Central Bank of Ireland data. And I suppose on average, when you look at that for the last 10 years, on average, the average amount that farmers borrow from Irish financial institutions is approximately 690 million annually for on-farm investments, not for personal investments such as cars or mortgages. It is for on-farm investments. You're talking about land, building stock, livestock, and machinery, and that has been quite consistent every year over the last 10 years. And of course, that doesn't factor in again what farmers are spending out of their own cash flow, which is on top of that 690 million on average farmers are borrowing or drawing down every year. In 2025, when we look at the data, I say we had data for the first 3 quarters of the year, and I suppose when we had the full year data, we expect it to be something similar to 2024 data, that it might average in the region of 650 to 600 and maybe 60 million of new borrowings taken on. Obviously, the dairy sector is a big proportion of that new debt being taken on. And interestingly, I suppose over the last 10 years, the lowest level of new borrowings taken on by the agricultural sector was in 2022 at 620 million, because of the relatively good cash flow year that the dairy farmers had. In terms of what farmers are looking for money and where they're asking for finance for, and I suppose just to give again a little bit of context, Stuart, every year AIB, we engage with Ipsos MRBI to do an independent financial services survey where over 1,100 farmers are interviewed, because we want to gauge appetite and we want to gauge sentiment, and we want to obviously get a sense of where farmers are looking to invest and what they need from us for the year. And when we did that, quarter one 2025 are the most up-to-date data. We're out in the fields currently, and we should have our next data in quarter one 2026. But when we did it in the data from quarter one 2025, it was interesting to note that 72% of farmers were planning to invest on their farm over the next 3 years. The average investment that they planned to spend was €62,000, which was both of those, the 72% planning to invest and the average investment, were up on the previous year in 2024. And I suppose, interestingly enough, then, where farmers were planning to spend their money was a third of them were planning on spending their money on compliance improvements or compliance requirements on their farm, which again, when we look forward to 2026, and obviously with the new nitrates directive and the increased slurry storage requirements from October 2028, we expect that to continue, and it'll be interesting to see when we get the data for quarter one 2026, will there be an increased appetite or increased demand for farmers, or will they be indicating to us that they will be investing more in slurry storage? We certainly feel they will, and we're there to support them. And because of that, Stuart, I just want to, or just to outline as well, and just to acknowledge all the good work that farmers are doing on their farm and the amount of progress that they're making. We can see the consecutive years of the emission reduction targets that the Irish farmers have engaged and bought into what needs to happen on farm. And to support that, AIB, we launched an Agri sustainability loan there last year, and particularly aimed at farmers who are doing the right things. And obviously pollution control is one of the areas that farmers can apply to AIB and for an investment, if they are considering doing that investment throughout the course of 26 or in the next year, 2 years.
I suppose it's interesting enough, actually, now, Donal, what you said there, in that there was 33% of people looking at investing in compliance ever before there was an actual genuine indication that the slurry storage was going to increase, so that people were thinking about it already, looking at it maybe from the point of view of, say, of replacing that fertiliser that has been removed, maybe by being able to store stuff for longer and carry it to different stages of the year as a result, and so forth. So that's really interesting. And
sort we have a team of 11 agri advisors located regionally around the country, and every day they're meeting farmers and they're seeing firsthand how farmers are engaged in what needs to happen on their farm. And I suppose from our point of view, it's excellent that there's probably a whole of industry response to supporting farmers through the government with some schemes and grant aid, through Teagasc themselves with the research and the signpost programme and the MAC curve. And then you also have the buy-in from the processors with their sustainability bonuses and their sustainability schemes, and right down to financial institutions supporting farmers with lower cost finance for greener transitional activities. So there's no doubt farmers are buying in about what needs to happen on their farm, because I suppose at the end of the day, and what we're hearing from customers, no different to any other body in the industry, they want to future-proof this sector for the next generation, you know.
Yeah, okay. So I suppose, like all of what you said there is very positive, and I do want to keep this positive. But obviously we can't talk without being reflective on the situation as it currently stands in terms of milk price, which is going to be an issue given what you said about the cost creep and so forth. So from your perspective, like Lawrence is always talking about resilience, and I'd say I've heard you speak about resilience yourself as well. What can farmers do to make their financial or their business more resilient from a financial perspective anyway? And that probably does link to the physical stuff as well. And all of that then lends itself to the farmer themselves being more resilient. Like if everything is going okay, there's going to be no pressure. But if there's pressure, like the farmer is going to come under pressure from a health point of view and so forth as well. Like, so everything that you talk about here is important. So what way, like from you see all those accounts that you look at and so forth, what are the key things from your perspective looking at those that is differentiating between the farm that's in the mid 30s, as you said there, versus the farm that's in the low 50s, maybe, that IFAC have highlighted? Like,
And I suppose, again, just to put it in context, and like what's really noticeable, as we all know, is that how pronounced the volatility has come within the dairy sector, particularly since maybe 2020, 2021, where we see swings in average dairy family farm income. It can swing nearly 100,000 euros in a year when we look at maybe 2022 versus 2023. The swing there in family farm income was over 100,000 euros. You know, obviously 24, 25, it recovered, but obviously looking forward for 2026, it looks like it's going to be a bit more challenging year. I suppose what we would always say to farmers is ask the question, do you know what your break-even milk price? And it's talked a lot, and if you're Lawrence talk about it as well, trying to calculate what your break-even milk price. And this is the price of milk that you need to get to cover all the costs of running your business. And that is your variable costs, your fixed costs, but also your financial costs, because living expenses, your own drawings or your own director's enumeration, the tax liability has to be paid. And maybe a message I want to give to listeners also is we would recommend this year to go away and do your 2025 audited accounts as soon as possible, so that you have some indication of what your tax liability will be in Q3, Q4 based on last year's profitability, so that you can be preparing for that and it won't come as a surprise. So again, your break-even milk price, your financial costs, be it your living expenses, your tax, and then also your bank repayments. I suppose what we say in regard to building a resilience business, and what level of a buffer fund should you have to make sure that you kind of have a smooth running of your operation for the year. So again, couple of things and couple of points. I suppose first and foremost, in relation to working capital, we always suggest to try to have at least 500 euros per cow available to you to fund working capital at the start of the year. And that can be either working capital available from the bank, it can be trade creditors that you pay down, that you have opportunity to build up again, or again, indeed, it could be stock that you have in your yard that you will be selling throughout the maybe Q1 or Q2, when we know the increase in the value of livestock over the last 12 or 18 months. But try to have that 500 euros per cow available to you in working capital over when you're coming into the start of any year. In terms also then of where you have debt on your farm, and again, what we like to see, particularly where guys have debt per cow greater than 3,000 euros, to try in a good year to put aside a buffer that will fund 12 months repayments, so that again, when you have a difficult year, that there's no financial draw off your farm to meet those bank repayments that you have contracted to, and that you can use your buffer fund that you built up to fund the repayments, and easing that pressure on you financially, but also easing financial pressure eases mental pressure as well. And particularly also, Stuart, and it's becoming a little bit more commonplace. And again, it's a good trait of farmers, and we've seen it coming through, is that they want to pay down debt quickly, and they want to clear debt fast. Um, and I think the average debt, the average debt might be 5 or 7 years that they want to take it out. But we'd always recommend that to take the debt over as long a period of time as the bank will give it to you. Because if you have a lot of short-term debt, it can put pressure on you in terms of cents per litre repayments. Your overall debt could be fine in terms of borrowings per cow, but it could be all short-term debt and that you're clearing down but in a period of a low milk price that can cause cash flow pressure and put you under a little bit of pressure if all your debt is over a short period of time. And as I say, your borrowings per cow could be within normal recommended guidelines, but your cent per litre repayments could be very high because it's all short-term debt. Obviously, focus on costs. Again, is there areas we've seen that cost creep, and we mentioned it earlier in our discussion about where costs have started to creep up, particularly on dairy farms, and looking at is there areas that you can focus on to strip back costs to get back on track.
The final question, Donald, then is like you talk about that cash spending that's happening on farms as well, and we often talk to people or say to people that they shouldn't be doing that. Now, it's obviously positive, and they'll say, oh yeah, look, sure, AIB are in the business of selling money, sure, they want us to borrow the money, obviously, like, but that's actually coming from a very good place from all our perspectives in terms of, like, it's great that 2025 was as good as it was, but like, as you said there, like, and it's great advice around the tax accounts to get them done as early as possible, because there'll be a big tax liability there, and obviously the preliminary tax then for the next year is tacked onto that as well, so that's going to be quite substantial. So even if we just look at it in the context of the tax bills, like, people probably should consider taking out a loan to cover that, rather than taking out a big whack of cash and paying it, like, even if they had the cash.
100%. And it goes back to that volatility that we've talked about, and that swings those really pronounced peak to trough ratios that's now very evident in dairy farming income. And we'd always, and you touched on it there, Stuart, we always mention if you're doing a capital expenditure project, to fund it out over an appropriate term, to keep your cash, build your own cash, and create that buffer fund, because you know, as sure as like night follows day, and we've seen it from 22 to 23, we're seeing it again from 25 to 26. There is drops, or your income can swing rather dramatically in a 12-month period. And the good thing about, I suppose, when you take out, and if you keep it on a variable rate loan, that you can always pay it ahead of schedule afterwards, but you have the cash flow available to you to allow you to do that, but also allow you to run your business during a poor output price year. So again, term it out over an appropriate term, and allow you to build that cash flow. We do it, and you touched on this, sort. We know that a lot of guys spent their own resources and their own cash on funding capital expenditure over the last maybe 12 or 18 months, and be it a capex project or even machinery, and that's why I suppose we feel that we can, in AIB, we can retrospectively fund that capital expenditure for 2026. So again, if a farmer has spent that 20 or 30 or 40,000 euros on a calf house or on a slatted house or on a silo slab or whatever, and funded it out of their own resources, and now find themselves a little bit tight coming into 2026, we can retrospectively fund that capex, put their cash flow back into their business so they can run their business for the year and term it out over an appropriate term. Which I think might be a good solution for farmers if they are feeling a little bit of cash flow pressure coming into 2026.
Yeah, so just to pick up on that there, and like Patrick has been talking about that 500 cow since before Christmas as well, like, and I know I've met a few people that are getting a bit spooked by it to a certain extent, and you've explained it quite well there, that it's not actual 500 dry cash sitting in the bank kind of situation, it's just facilities that you have available to you. So if people are looking, if they're following, listening to what you just said there, and they're looking at their own situation and they're saying, right, geez, we actually are getting tight here, what should they be doing in terms of doing something about it?
The first thing I would say to them, Stuart, is try to quantify the level of support you need. Do a cash flow for your business, or alternatively, do try to calculate your break-even milk price, or if you're not sure how to do that, our Agri advisor team are there to support you and can do it with you. So either you do a cash flow for your business for the next maybe 6 months, or try to calculate what's your actual break-even milk price, because that will identify the level of support that you need. So then once you know that you need support, that there's a cash flow deficit for your business over the next maybe 6 or 9 months, then what are the options available to you to fund that? Is there buffer funds? Is there cash reserves to come in to support it? Is there trade creditors that can be used to support it? Or indeed is bank support required? And we have a range of options there, Stuart, to support any farmer that needs cash flow support. There's no one solution for every farmer. Obviously, guys, think about increasing the overdraft. We have a farm credit line. We can retrospectively fund capital expenditure. There's term loans, there's interest-only options, and so on and so forth. So it can be either one or a combination of those may be best suitable for your farm. But the most important thing, Stuart, is quantify the level of support you need. Come and talk to us as early as possible. But it's important to quantify that level of support, because that allows us to get it right first time. There's nothing worse than a farmer coming in and saying, I think I need 20 grand. That's good for then 2 or 3 months, and they're back in afterwards saying, actually, I need a 40 grand, So we want to get it right the first time to put the right amount of support in place for your business for as long as you need it. So by quantifying that support, that allows us to get it right first time.
Okay, so is that down to the fact that we'll say maybe the people in Dublin, as they're often referred to, don't maybe understand or don't like the fact that people are coming back so quick again? Like, is that like, because you understand the situation on farm, obviously, but it has to go through credit control and so forth?
Not really, Stuart, but it's like when you're dealing with a customer, you want to support them with whatever cash they need for running their business. There's nothing worse than actually squeezing a business in cash. And like, cash flow is so important. It's more important than profitability. And there's a big difference between profitability of business and cash flow support for your business. So as a lending institution in AIB, we want to make sure for any business that we're not squeezing them with the cash flow that they require to run their business. So it's making sure that we get it right first time and put the right amount of support that they need to run your business for the year.
Yeah, so ultimately what you're saying there is if you come looking for the wrong number in the first place, it ultimately lends to maybe making bad decisions subsequently because you're tight again and you don't want to go back to Donal again asking him because I got it wrong the last time, kind of.
And that's exactly it. Farmer says, I got 20 or 30 grand, but actually I underestimated that by X amount, and sure, I can't go back to the bank again and ask him again, because the perception might be that I didn't do my cash flow budget correctly or whatever, but look, look, Stuart, there's always things that you thought the weather was going to improve. You thought you were going to have cows out in another 2 or 3 weeks and the weather didn't improve. Things change. Farming is very volatile, as we know. It's our job as Agri advisors or the Agri team in AIB to explain to our credit people about, actually, we thought 20 grand was going to be enough, but it didn't turn out to be enough because A, B and C happened, or the weather hasn't improved and cows haven't been turned out, etc. So there's always things outside of farmers' control that will impact that, and that's our job as the frontline team in the AIB, the Agri team, to explain that, and that's our job.
Okay, so the last one then, I suppose it's a myth buster for you, because from what you said to me there a while ago, the people in Dublin are responsible for these awful long delays with getting money sometimes, and it puts people off going to talk to you. You've actually very quick turnaround in a lot of cases.
Yeah, and like, our business in AIB, and I think in the agri market, you can explain it by that it's a high volume of relatively low value applications. So we do a lot of applications, 5, 6, 7,000 drawdowns a year of relatively low value, where the average loan amount that we lend is less than 50,000 every year. So we do a high volume of relatively low value, So for the vast majority of those low value, I won't say low value because I'm not trying to undermine 30 or 40 grand. That's our bread and butter. That's absolutely the business that we want, and I'm not trying to undermine that. It's not a significant amount of money. But the majority of those cases, we know our customers. We know that they can be supported. And when I actually look at our average time to decision for our 2025 applications, nearly 80% of farmers got an answer within 4 working days. That being said, I know there's listeners going to be listening to this and that wasn't their experience with dealing with us, and there can be scenarios where we will need more information, or we might be dealing with a complex structure such as a limited company in partnership with a sole trader or a farm partnership, and we need to understand where the cash flow is going, and those scenarios can take a little bit longer. That being said, we have a service level agreement that we have to adhere to, Stuart, so that once we have all the information from a customer to make a decision, we have to get back to that customer within 15 working days, and we try to adhere to that insofar as we can.
Overall, so Donal, very positive position. Obviously 2024 a little bit more challenging, and we don't know what the year will hold, but obviously, as you said, the cattle prices are quite good, and calf prices have started out at a phenomenal rate at the moment as well. So just if people get a bit of time, busy at the minute maybe, but as soon as they get a chance, like when you talk about cash flow, you're not talking about spreadsheets here now, you're talking about the copybook and just figuring out what's going to come in and what needs to go out and so forth, and that's as simple as we're talking about.
That's as simple as it doesn't need to be anything elaborate here, Stuart. It's just what you expect to get in income and what bills you need to write for the month. It is a copybook, and they're the most effective cash flows, because it's the farmer realising themselves, this is what I project to come in, this is the amount of milk I should have at whatever mid price it's going to be, mid 30s or hopefully high 30s, whatever it's going to be, and then who needs to be paid for that month, and that's your cash flow. And then from that we can determine then, okay, this farmer needs X amount, Y amount, that it's our job then to put appropriate solutions in place for the customer.
Very good. So a positive scenario, and just be conscious of people's own positions, and to move early is the big thing really. And I think great advice there around the tax accounts, like as soon as the heat of battle is over there now with calving and stuff, to be taking some bit of a day and trying to put the accounts together and get them into the accountant and get them sorted, like.
And the other thing I'd say is, Stuart, to anyone that's listening, and again, we saw it in 2023, we fully appreciate and recognise that pressure can build quickly, particularly in a low milk price year. And it's important that farmers, you look after yourself, you look after your family, you focus what's within your control, such as maybe looking at your costs and looking at grass utilisation. But just to be very conscious, your farmers, you're not in this alone. And we saw 2023 was a difficult year for the sector, but we saw how it rebounded in 2024, 2025. And I suppose that's the other maybe last message I would give another message I would give also, is that when you're making an investment decision on your farm, it's important not to look at the performance in any one individual year. And some farmers might be listening to this and saying 2026 is going to be a difficult year, that I'm going to put away the checkbook for the year, I'm not going to do the capital expenditure, and that might be the right thing for you to do. But what I would, and how we view any decision that we make, we look at the performance over the last 3 to 5 years, or 5 or 6 years, or whatever number of years we have a track record for that individual farmer. And when you do that, for the last 4 or 5 years in the dairy sector, it's a positive position, recognising that 23 was a difficult year, 2026 may not be so rosy either, but on average over the last 4 to 5 years, it's a sector that we're very confident in the long-term future of the sector.
It is important to say it like that. It's a long-term investment scenario there. Like, geez, people shouldn't be thinking that the compliances you were talking about earlier needs to be done out of cash or anything like that. If the plan is there to do something this year, just go and finance it. And sure, if you, as you said, if 2027 turns out to be a bumper year again, sure, you can blow it away if you want to get rid of it. But like, not to invest in 2026 is going to be a bad idea, basically, because the close periods are going to be extended, the close periods staying the same, but the storage requirements are going to be changing, and like, that's going to come up on top of us awful quick. That's the challenge that people are going to be faced with. And what happened in nearly 20 years ago, basically, was there were people absolutely coined it out of people who needed to get the storage in place, or they were going to be non-compliant effectively. So people should get, if there's a job to be done, go talk to yourselves and others and just go ahead and do it the right way.
And you overlay that, Stuart, in with the availability of guys to do the work. Like, you know, we don't want to leave this to the last minute and everybody trying to increase their slurry storage before October 2028 and not being able to do it. You know, so 100% from our point of view, we won't look at any year in isolation. We look at the track record and the performance of the farm over the last 4 or 5 years, and that will be the basis for our decision. It's not the individual performance in any one individual year.
Very good, Donal. So super talking to you, and I hope we'll be walking out of Croke Park in July on a happier note than we were last year, and that we'll be talking about a super milk price by that stage as well.
I hope you've the red bunting up already, Stuart.
We have, Donal, we have. Thanks a million, Donal.
Thanks.
That's all for this week's episode of the Dairy Edge podcast, and thanks to Donal Whelton for joining me on this week's show. Don't forget to rate, review and subscribe to the podcast. You can listen on Apple and Google Podcasts as well as Spotify. And for more information, go to the Teagasc website at teagasc.ie. I'm Stuart Childs, and join us next time for your Dairy Edge.